All right, well, welcome everyone from the CFA Society of Detroit. I'm Vince Vitale, your current standing president. I'm so glad to have you here today and so glad to have Danielle DiMartino Booth as our guest speaker. She's going to be wonderful today. Some general housekeeping here. I'd like to mention some upcoming events. Finally, starting in May, we'll do some socially distanced in-person event outdoors at Topgolf. That's on May 6th. The day before that, we have another virtual event with First Trust senior economist Andrew Updike. Thursday, May 20th, for all you financial advisors out there and anyone else just in the sort of service industry, digitizing your practice for the future of financial advice, presented by Alex Cavalieri. That's on May 20th. Friday, June 25th will be our annual meeting. We'll have that at the Detroit Athletic Club. Anyone that may be interested, if it's allowed, we may be getting tickets for the Tigers game. And then lastly, this summer, July 20th, we'll have our summer golf outing. So with that, let me introduce Danielle DiMartino Booth. She is the CEO and Chief Strategist for Quill Intelligence, LLC, a research and analytics firm. Prior to Quill, Danielle spent 9 years at the Federal Reserve Bank of Dallas, where she served as advisor to President Richard Fisher throughout the financial crisis. She is the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. So very interested to hear all about that. And with that, let me let you take it away, Danielle.
Vince, thank you so much. And thank you for having me. I'm going to tell a funny little story about the job positions that I turned down. This is always a good way, especially when we're meeting virtually like this. And by definition, it's not exactly a warm ambiance, if you will. I'll be at Topgolf if I can make it myself, because it's already summertime here in Dallas. Topgolf is already icky hot. But in any event, when I was getting out of business school, I had 3 options available to me. I'll make this long and short and sweet. My mother was determined that I stay in the state of Texas. I explained to her that I didn't really think I was a bean counter. So I turned down Arthur Andersen, even though they'd offered to put me up in corporate housing and rush me through my final 9 hours to sit for my CPA. I said, Mom, I don't think I'm an accountant. So I turned that down. She said, well, what about that place in Houston? And I said, I get it. I understand a lot of the things that they're trading. On the other hand, some of their business models a little bit confusing to me, Mom. So I'm sorry, but I'm going to turn Enron down too. So it ended up that I was off to New York, bright lights, big city, Donaldson, Lufkin and Jenrette, an investment bank that is no longer with us, a bank that's in the news just a little bit these days, Credit Suisse. They bought out DLJ and spent way too much money and incurred billions of dollars of losses on that purchase. Would you believe that? But in any event, it was great while it was DLJ. I learned a lot. I thought I was going into retirement. I'd sold my book of business back to the firm, signed a non-compete, agreed to leave the industry, and really just started writing about the markets on the side. And that's what got me the notice of first Warren Buffett. That was a lot of fun, being invited out to Omaha. Charlie Munger's a lot more interesting. Make a side note. And eventually it got the attention of Richard Fisher, where I became one of his chief advisors there throughout the financial crisis. So when he retired, I retired and founded Quill Intelligence with my independent research firm, which is what brings us to where we are today, looking back at those crisis months and how far we've come. Well, I would say we've come a little bit further than the time leading up to the peak in inflation. If you want to look at that inflation with this first slide through the prism of asset price inflation. Now, one of the reasons that I wrote the book Fed Up, an insider's take on why the Federal Reserve is bad for America, a very subtle subtitle there, is that it was recognized in the aftermath of the financial crisis that that the Fed had not recognized that asset inflation played a critical role in trying to determine when Fed policy was causing an overheating of a different kind than we're hearing about today, but rather an overheating in the financial markets. If overly easy monetary policy was in and of itself a source of destabilization. Of course, we learned that that was indeed the case, but stock market valuations never got near as high as they were in 1999. In fact, if you go back to the longer history, you see that today, where we are at 38 after yesterday's close or so, but where we are today is not only higher up than it was at the beginning of the year, but a multiple of about 7 times more than what the price to earnings ratio on the S&P 500 was in December 1920. So when it was 4.8 times, the cheapest it's been in history that goes back to 1870. That gives you a little bit of perspective on some of the December and January previews and outlooks that we were reading about embarking upon the next roaring 20s, decade of the roaring 20s, this being some kind of an encore. That doesn't typically happen when stocks valuation is 7 times that of what it was when the stock market was on the precipice of the roaring 20s of the 1900s, where valuation started out at 4.8 times and eventually peaked out at 32.6 times. Again, you will see that we are higher than that today at about 37. So the only comparison that we have is the 1999 dot-com bubble at this point. Again, valuations are not timing mechanisms, but they do give you a good feel for what future results are going to be, given how overstretched they are. So one of the post-pandemic, especially phenomena that we've seen is you notice that there's a big spike down post leverage. There was a gradual decline, but there's been a lot of equity issuance that's gone on in recent years, and especially over the past few years. Just last night, I saw Invitation Homes. It's the largest single family rental company in the country. And I see a few of these every trading day, and they're non-deal trade, they're non-deal non-deal roadshows, excuse me, I was looking for the right term. And all that means is that companies know that they can raise equity so easily in the current environment that they don't even need to bother with a roadshow to investors. Investors just know to pony up and pay. But again, this masks leverage the likes of which we've never seen on US corporate balance sheets. A separate phenomenon that I want to bring to your attention is margin debt. So we're going to talk a little bit today about where we were in 2017 versus where we are today, because the biggest disparity between the two is the retail participation. You may note that in early 16 that margin debt had come down. Again, it had come down and stayed at a lower level than it was compared to where you see it today. That margin debt has run up alongside the market capitalization of technology firms that are losing money. Here we put it politely, diplomatically, negative earning IT firms. But you see that tremendous run up. It has started to come off a little bit with the NASDAQ sort of beginning to correct. But again, we're up at all-time highs with all the major indices, and margin debt is right up there as well. That was not the case in 2017, which brings us to this next slide. So back in, call it 10, 13, 16, through those 3 years, through 19, excuse me, retail investors learned to despise stocks. And I'm talking about direct retail participation. We've obviously seen the advent, the runaway train of passive investing and the way that individuals' 401ks are now managed and some of the types of investments that you see in them. But the reason I bring up the retail investor is the last time that there was any kind of true disruption, true anxiety in markets was late 2017. We had a new Fed chair coming in by the name of Jerome Powell. You may recall that on his first day in office, in 2018, that the Dow Jones Industrials dropped more than 1,000 points. Coming into 2018, the VIX, which has just seen a record run north of 20, and just in the past few days, ticked back down below 20, much to investors' relief. But in 2017, which market veterans look back on and call the year of complacency, the VIX index, people's perception of markets' ability to correct, the VIX index was south of 10 in single digit territory 54 times in 1 year. And that is a mirror reflection of the other side of that trade, which is, and Google it if you've never heard it, because it was such a huge problem going into 2018, was the sheer magnitude of how crowded the trade was with short volatility. So if you're short volatility, you're basically saying, I think that the value of volatility is going to decrease as a factor of time. So I'm going to position myself to trade that. Well, that was all institutional investors. And it remained that way until 2019 and when COVID hit. But throughout 2017, 2018, Volmageddon, that early 2018 trade where stocks completely fell out of bed. Then there was and we'll get to this in a little bit when we talk a little bit more about credit, but then there was the Halloween downgrade of General Electric's debt. And that Halloween downgrade led to the Christmas Eve bloodbath in the stock market. And that generated the Powell pivot. And the Powell pivot, which came in early 2019, was basically a recognition on the part of Jay Powell that he was not going to be able to normalize interest rates. I'm jumping ahead here, we'll go back. That he was not going to be able to normalize interest rates. Jay Powell was determined to get the Fed funds rate to 3%. He did not succeed. He was determined for quantitative tightening, the shrinking of the Fed's balance sheet, to be, as his predecessor, Janet Yellen, said, like watching paint dry. Well, it was, unless the paint was blood rolling down the walls, it was not like watching paint dry. And the fact that there was this double tightening going on created this situation in markets that were primed for a mistake to happen. And that's what brings us to these next two slides, and I'll pop back up to the others that we skipped through. But as you can see here, since 2013 or so, firms' interest coverage, despite the fact that interest rates have been on the decline for as long as they have, firms' ability to service their debt, the orange and the red lines, have been on a massive, massive decline to where you see they are today. And that is why this explains more than anything else why when pre-pandemic we had 14% of US firms, give or take, that were zombies. They didn't make enough money to cover their interest. Now we have 1 in 5, 20% of US companies are now zombies. So despite the fact that the Federal Reserve has interest rates at the so-called zero bound at 0%, you've got companies that are struggling to pay their interest expense if you look across the entire universe. The flip side of that is you've got gross leverage. And I know that this is something that Wall Street loves to do. This is a JP Morgan, JP Morgan data here. They love to X out metals, mining, and energy right now. A few years ago, it was different industries that were causing distress, but that's what Wall Street always does. You always X out that one little industry that's causing the data to not look so good. And that's why the green line is a little bit lower than the blue line, is if you take out that energy sector where there's still such an overabundance of leverage that we do anticipate to see continued insolvencies in that sector. But again, higher than what we've seen in the post-Great Financial Crisis era. That has led to This is through the third quarter of 2020. This is the most recent that I could get, but that has led to what you're looking at right now, the bell curve, the distribution of the investment grade, and I'm going to use air quotes here, the investment grade US corporate debt universe. If firms were to be rated by the credit rating agencies based on the fundamentals of their actual balance sheets, and they're not, but if they were to be, then 54% would be rated as BBB or lower, junk bonds or lower. It's critical to appreciate that that's the majority of the market. In fact, when you look at BBB in isolation, it is and has been for several years now over that 50% line in terms of its weight in Barclays Corporate Index. So the only thing we can say is that the market value of BBB debt did not continue to increase into 2021, but it is stabilized at a very, very high level. In other words, the risk in the BBB bond universe, which comprises more than 50% of investment grade, has only been exacerbated in a post-COVID world because of what the Fed did a year ago, March 2020. Now we're more than the 1-year anniversary past the big bazooka, but rolling out those credit facilities, deciding to bail out the US corporate debt market had to do with Jay Powell grandfathering in, mind you, Ford and a few other big issuers that were downgraded, that we call them fallen angels, when you cross that barrier from being investment grade into junk. But it was because of this specifically that Jay Powell did not want for the high yield bond market to explode in size and have that many investment grade issuers recognized by the market and have their bonds trade at market levels. He was afraid of what the cascading effect would be, what the systemic risk potential was, because you had anomalies that have started to correct since then, where one Japanese bank in particular held more than 40% of their assets in collateralized loan obligations that were potentially backed by some of this pseudo investment grade, truly garbage junk bonds. So there were many different unknowns in a post-COVID world that Jay Powell was trying to get out in front of. And you may recall in late 2019, the Fed was already engaged in what they called not QE, holding the purchases to grow the Fed's balance sheet at 12 months maturity or less. And the reason that I like to say, and I don't say this tongue in cheek, I happen to know that after the 2018 bloodbath in the stock market, in the credit market, when high yield trading froze for 41 record days, there was not a single high yield bond sold in America. It was then that the officials at the Federal Reserve got together and said, in the event of a black swan, we now know we have a huge problem on our hands. We need to come up with a game plan. And that is why on March the 23rd, 2020, they were so organized in their approach to bailing out the corporate bond market that had kind of gone haywire in the late months of 2018, leading up to the Powell pivot, when he apologized for not advocating for quantitative easing when he was first on the board of the Federal Reserve Board in mid-2012. So I would be remiss to not bring up housing. It's hard to say that any major city that is not considered to be a major metro area has not been affected since March the 23rd and the Fed's quantitative easing program. As you can see, expectations for suburban home price gains, they almost need a different scale, ISI, because they're so high. The opposite is the case, of course, with urban, but even rural out in the sticks, even anticipations there are the highest that they have been in years as we continue to bear witness to this mass exodus from densely populated urban centers. So we could speak for a whole day about the implications that this has, excuse me, for central business district office supply. That's going to be a cripple asset class for we don't know how long. But we do know with the yellow line that right now, households' expected change in home prices in the coming years in the coming 12 months, excuse me, is higher than what it was in 07, as we know that the subprime crisis was coming on. So there is this fundamental driver. Boise, Idaho, Austin, Texas are the two hottest housing markets in the nation right now. There's this exodus out of California and other high tax states. Illinois is, of course, being hurt. New York is being hurt. New Jersey. But the flip side of that is you're actually making housing more expensive nationwide in the aggregate. You've got home prices in Austin rising at a 30% year-over-year rate. It's insane, hard to describe. But it's not just this fundamental driver. It certainly isn't because all millennials have all of a sudden landed their dream job and no longer have that anvil of student debt dragging them down. A lot of it has to do with the fact that the Federal Reserve owns and is purchasing every month $40 billion worth of mortgage-backed securities and owns about a third of that market. And at the same time, if you're bored, if you have insomnia, if you want to Google automated appraisal waiver, Fannie Mae, Freddie Mac have been engaged in not having human beings go to homes, not having appraisers, warm bodies be in homes to appraise the values of home, but rather, as they did with liar loans a generation ago, allowing buyers to kind of work their way around the system with an appraisal that is not verified by a human being. More than anything else, this has driven refinancing and refinancing values, where last year we saw cash out refinancings hit at their peak, a record run rate of $100 billion per quarter. So look at that as being another one of the benefits of being at the top of the K-shaped economic recovery post-pandemic. Is you're exposed not just to the stock market, which is the only thing that Fed policy has benefited, but you're also exposed to the housing market. So you're generating wealth. The wealth effect is a double barrel, if you will, because your home value is rising. You're able to take cash out of your home. You own those stock prices. Your portfolio is bigger in value than it's ever been. And so you feel wealthy, wealthy, wealthy. And then there's the bottom of the K. We'll get to the bottom of the K in just a minute, but it's just as meaningful for the trajectory of the US economy as the top of the K, I would argue. Well, we're going to Japan before we, okay. So this is where things get really scary. And because people always ask me, how does this end? Where does this end, Danielle? And the answer is, it's kind of hard to say. So this is not quite up to date. If it was, the blue line would be a little bit higher. But this is a very old chart that was created in the aftermath of the dot-com bubble here in the United States imploding. And if you see kind of where that blue line peaks out, that's when the PE on the S&P hit that 42, 43, 44 all-time high that we've seen again in data back to 1870. That blue peak that you see on this chart is this blue peak that you see at the very top of this chart. But the Nikkei at its peak prior to the 1988 implosion of the Japanese stock market that's led to more than 3 decades of lost growth hit 99 times earnings. So, I mean, that's why you always hear people quip that, the central market, the central bank can keep markets solvent for longer than you can stay short the market, and how very dangerous it can be to try and time the markets when policymakers, as they are today, you hear it in every single Fed speech that is given by Powell or any of his of his colleagues, they're all bound and determined to make sure that the stock market bubble that we have in the United States today, and make no mistake, it is a bubble, whether you were to look at this or price to sales ratio have obviously exceed that now of December 1999. Whether you're looking at the Buffett indicator, which is stock market capitalization, that now exceeds that of 1999. By the way, also on a global basis, right now, the Buffett indicator for global stocks exceeds that of any prior high. The prior high, by the way, was in 2007, 2008 globally. The 1999 bubble was very much an idiosyncrasy of the US stock market back then, more than 20 years ago. But again, regardless of the indicator that you choose to pull out, stocks are more overvalued than they've ever been. And yet, as you see, stocks can always become more overvalued. So let's get, as I mentioned, to the bottom of the K. Obviously, you're in the CFA Society. You don't need to be told about the value of an education, about the value of your CFA designation. In fact, too much information. We're in the process of hiring a sales director, and that was for my research company. And that was the initial colander that this person had to fall through, is that they had to be a CFA. And if they didn't, then they didn't even get into the first round of interviews. And what we've seen in the post-pandemic era, because we've heard a lot from the McKinseys of the world, that automation is going to be something that takes off. And by the time 2030 rolls around, or some date in the future, a third of America's workforce will be automated. All of these studies published in 2018, 2019, early 2020, all of those studies are now out the window. In a post-pandemic world, the push to automation is going to be dramatically accelerated. Even in smaller businesses right now that are having trouble sourcing employees. And the only reason, of course, they're having the challenge is because I'll give you an example from a report we recently published. If you were to look at a single working mother with one child under the age of 6 and one child between the age of 6 and 18, and if you were to look at all of the benefits that she gets with the latest $1.9 trillion stimulus bill, you add everything up between the rental eviction moratorium and the Obamacare premium being covered, her utility bill, the extra $300 a week, before you get to the first penny of stimulus checks, which she would have qualified for 3 times now. But just X that out, her annual intake is $60,912 based on the current stimulus. And that means that the K-shaped economy that I was referring to a few minutes ago, it's going to continue to get worse for the people on the bottom of the K unless we find a way of reversing some of the trends. Is one of the trends that is entrenched now, because we've been paying people to not work since the first CARES Act gave out $600 extra a week in unemployment benefits. So we either break that cycle and provide for true job retraining. People go back, get a trade, vocational, learn computer skills. We're going to have a lot of atrophy in the US job market for a long time. And the value of that postgraduate degree, that yellow line, it's going to begin gapping out more between that and just a bachelor's degree, simply because so many professions that were once you had to have a bachelor's degree can now be automated in this generation to come. So that is something that will act as a drag on inflation in the years ahead. And that is likely a good place for me to stop and ask if any questions have come in, because the talk these days has absolutely nothing to do with the talk these days has absolutely nothing to do with disinflationary forces, but rather inflationary forces.
Well, I will let a few more questions come in. Once again, for everyone that's attending, if you, at the bottom of the screen, there's a Q&A, please type your questions in there and I will ask Danielle. But let's start off with that, right? CPI came out today. Seems like the Fed finally hit their targets. And there's still the ultimate debate as I, listen to tons of different investment strategists and big banks and inflation versus deflation, right? And can the Fed produce sustainable inflation? We've had some transitory inflation, and historically, a lot of people have said the QE is actually ultimately deflationary, and the more debt that you actually have in an economy becomes deflationary. But I think this is the first time, as we see with all these stimulus packages, that they are sending money to people versus sort of getting stuck in the banking system. Mm-hmm. And there's also a lot of talks about possible digital currencies and other aspects to get money into people's hands. So I think, what is your take on the sustainability of this inflation? And do you think the Fed will cross that line, per se, to try to get money in the hands of people to ultimately generate inflation? Or do we actually see wage gains as corporations finally have to pay up for people to come back to work?
So these are all pertinent questions, and this is all the secret to what is to come. And the key to everything that you just said was central bank digital currency, which we'll get to in just a second. We know that had we had an unchanged reading after last year's March 2020 0.7% decline collapse in prices, that all we needed today was an unchanged reading to get us to 1.92%. Instead, we had a reading of 0.6%, which was at the outer boundary of Bloomberg consensus estimates, which caused the year-on-year rate to pop up to 2.6%. The core CPI increased to 1.6%. Since the 2% target was first imposed, the Fed has hit that 2% core target, I believe, 7 times. So in well more than a decade. A lot of it has to do with the construct of the CPI and what the Fed uses, the core PCE. They systematically underrepresent housing and healthcare, 2 of the largest inputs to price pressures for your average household. And that doesn't even bring into account the fact that they don't even enter into the calculus, of food and energy, which are obviously 2 other major drivers. But just looking in isolation at that core PCE and the prospect that or let's look at the core CPI since we have the data on hand, and the prospect that it's going to pop above that 2%. I think with base effects, given the fact that we have 0.1% year over year in May of 2020, it's quite conceivable that we see 3%, 3.2%, 3.3% over the next few months. The question is there going to be pricing power that follows? And to Vince's point, will there eventually be the true inflation that gets economists' attention, the true inflation that would get Jay Powell's attention, and that's wage inflation. We had National Federation of Independent Business out on the wires with fresh data that showed that 42% of small business owners in America cannot source the skilled labor that they need right now. Separately, they said that 25% of those who were surveyed who did bring on employees had to pay higher wages. So we know that wage inflation is an emerging phenomenon. What we don't know is if it's going to be endemic, if it's going to be across the entire spectrum. If you look at the job openings right now, there's a great website that's a post-COVID creation called Opportunity Insights. I think I got that right. But it's literally been my absolute go-to since the pandemic, because it provides you with, Opportunity Insights, their economic tracker. And it provides you with not just job openings, but job openings given a certain level of education attainment. And at last glance, the employees with the least amount of education, typically you're talking about not even a high school degree, job openings for that cohort are up 63% year over year. Job openings for those with extensive, the most, we're talking about postgraduate plus education, those job openings are still down 2.8% year over year. So the real wage inflation that we'll see is not if small business owners are going to have to pay up for low income earners to come back into the workforce. The real wage inflation that we would, in fact, if, you know, for all the base effect cocktail conversations that we're having right now, those huge base effects, for April average hourly earnings, when that big non-farm jobs payroll report next hits the wires, next jobs Friday, if we don't get a print that is 0.4% year over year, that's a big honking gain in average hourly earnings. We're actually going to print negative year over year for average hourly earnings because the vast majority of the jobs that are being created are in low paying industries. So in the very beginning of the pandemic, the vast majority of the job losses were in low paying industries. So we saw year over year average hourly earnings pop way up. So my point is, we're not necessarily going to see wage inflation that gets Jay Powell's attention if higher paid workers don't start to see increased salaries. And that is your true source of true inflation that has staying power. We know that the Chinese supply chain has been largely repaired. We know that the Chinese are none too happy that they lost market share to higher cost US producers who have supplied US manufacturers. And we know that because they've got so much overcapacity and all the shipping containers in the world, that if they want to start out right now and try and get back some of that market share by undercutting higher cost US suppliers, that the time is right, because the margin squeeze in the factory sector is on, and we've heard about it. So again, they've got the shipping containers in Shanghai to alleviate a lot of this shipping cost disruption, and they've got the supplies as well to send our way. So I would say that a lot of the supply chain disruption that we continue to hear about, spiking input costs, that is going to be something, to borrow Jay Powell's favorite term, is transitory. We know base effects end after May's print in mid-June. So, and we also know something else. This is beyond the scope of your question, but I should share that consumer credit, household balance sheets have been on the mend for a generation now. And in fact, post-COVID, we saw a real crash in households using their credit cards. Hence the surprise, not to me, I actually saw this one coming, but because on February the 3rd, we learned that the Democrats had the votes that they needed to open the debate for the $1.9 trillion stimulus bill. So that hit the wires on February the 3rd. On February the 3rd, the world basically knew that the $1.9 trillion, $1,400 stimulus checks, average family gets somewhere around $4,000, that was money good. And so we saw a 10.1% spike in revolving credit in February data that was released last week. I was in Orlando, Florida, miserable at Disney, never going back, but I was personally witness to those stimmy checks being spent, and the fact that airline fares have gone up, and the theme park tickets, the money was spent. Bank of America has daily tracking data on credit and debit card spending, and to them it looks like that spending spiked around day 6 after hitting the direct deposit accounts throughout the Bank of America system, which they can blindly, anonymously see in their system. A lot of it was also saved. But what we do know is that in order to maintain these spending habits, we're going to have to continue to come up with new sources of stimulus checks. And I just don't know, because of how the Biden administration is crafting the new legislation under the guise of being infrastructure spending, if they're going to push that through with reconciliation on a pure partisan 50-50 line, and possibly tax increases, I don't know what the appetite is going to be to get in an election year, which we're coming into, the GOP to agree to more big fat stimulus checks. So that source of services spending should percolate through the economy, but then also prove to be transitory. Again, unless we see substantial increased and maintained increases in wage inflation further up the income ladder, further up the educational attainment ladder.
Okay, so definitely in the transitory camp, and towards the back half of the year, we should see some much moderation unless they can continue stimulus or a ton more people get back to work, correct? I mean,
a ton more higher paid workers get back to work.
Correct. So, all right. One question here, and it's probably spurred on a little bit. The long end of the curve, right, has gone up substantially over the last 12 months, right, from 0.45 on the 10-year up to 1.7 here today. If inflation does, for whatever reason, become more sustainable and the long end continues to move up, there's talk about yield curve control, right? We have a massive debt load. How high can rates actually be, go without the Fed trying to control those? What would that look like? And, what would be the impetus for them to actually, what level of rates maybe would they actually consider doing something like that?
Sorry, I was checking to see where the 10-year was and squinting without my reading glasses. So I think that yield curve control is not necessarily a quantitative bogey, a threshold, if you will, inside the Eccles building. I think yield curve control is something that could possibly be rolled off if and when the wheels fall off. I will tell you, when we had the NASDAQ declining dramatically and we had large moves in the 10-year and in the 30-year, and they were kind of spiking up by double-digit basis points on any given day, that got the attention of Federal Reserve officials. And it wasn't necessarily because of the absolute level, but it was because of the delta and the follow-through effect it was having on the longest duration holdings in investors' portfolios, which are technology stocks. So you were seeing a one-for-one trade-off with the NASDAQ and the rapidity of the rise in the 10-year. So as long as there is a measured rise in long-term interest rates, a basis point here, a basis point there, we're back down to 1.64 today. So as long as there is a measured rise in those long maturity treasuries, I don't think you're going to cause the Fed to blink and launch yield curve control. They will stick to their narrative that the increase that is controlled in long-term interest rates is purely a reflection of an economy that, as Jay Powell said on 60 Minutes, is at an inflection point and poised to run at its best growth levels since we emerged from the 1981-1982 double dip recession. And I think that they will stick to that narrative as long as there's nothing dramatic. If we wake up tomorrow morning, or if we wake up with the April print and it looks like a 4% CPI print instead of a 3 or a 3.2%, which the market has fully priced in. We're seeing today that the market had fully priced in where CPI printed, or we wouldn't see the 10-year yield lower than what it was headed into that report. But if we wake up tomorrow and if there's something bigger than the Suez Canal, or if there's something that definitively says inflation is going to stick around for longer than we anticipate, and you get a spike up to 2% in the 10-year yield, for example, and you get an immediate correction in the NASDAQ, and the rapidity of the increase in the 10-year yield was sufficient to put the NASDAQ into correction territory. And if you see the follow through, as we've seen in the MOVE index, the sister index to the VIX, but for the bond market, that has popped up above the 60 level and remains close to double its post-pandemic low. And LQD, the largest investment grade ETF, has not fully recovered. And that shows you that nervousness around the credit markets, which are very obviously dependent upon interest rates staying very low, that nervousness has continued to persevere. If you want to look at a huge contrast, look at a short duration high yield fund and see how well they've performed this year compared to obviously a longer duration investment grade fund or exchange traded fund. High grade has hundreds and hundreds and hundreds of billions of refinancings that must be done in 2021. The same goes for commercial real estate. $420 billion of commercial real estate debt has to be rolled over in 2021. High yield, 47 billion. Who cares? And it's a much shorter duration asset class. But if you were to start to see seepage into high grade bonds, seepage into the NASDAQ, you could possibly prompt the Fed to move. Otherwise, you're going to have to cross the Rubicon of changing the Fed's liabilities into legal tender and delivering them directly into people's accounts at the Fed, such that you have whatever, you have runaway hyperinflation. But that's a big Rubicon to cross.
Another question here was, you had the chart on Japan. So what would have to happen for the Fed to change course? Like, will this pop the bubble like in Japan, right? Like, clearly equities are priced across every metric, 99th percentile roughly throughout history. Some people also say, is that, sort of transitory? I mean, a lot of measures are over, like the CAPE is over a decade of earnings. So 1 year fall from the pandemic shouldn't really affect that too much. But obviously earnings are set to grow a lot this year, which should maybe take a little bit of pressure off of where valuations are, but they're so dramatically overvalued. And it's one of those things, people are chasing themselves into risk assets to find yield wherever they can, since bond yields are so low, et cetera. What would have to happen though for people's mentality around where valuations are for that to reverse course? I mean, they've been elevated for a long time. I mean, it's gotten worse, but they've been elevated in this whole since 2000. Really, we haven't ever come close to the 6 PEs of 1982 or 1920, right? So it does seem we're in this like new higher valuation regime. But what would cause that to come undone?
So I think the ultimate, remember what got us where we are now, almost record valuations or 99th percentile across the board. It wasn't just monetary policy. It was the combination of monetary policy, which props up risky asset prices, plus fiscal spending, the likes of which we've never seen. Call it just around $6 trillion. So 25% of GDP. The game changer in the current past 13 months has been monetary policy working hand in hand with unprecedented in US history fiscal policy. So ask yourself the question again, pick up any newspaper, Mitch McConnell's pissed. Pick up any newspaper, the GOP is not happy. And the Senate parliamentarian who is, she's outside of, she's not an elected politician. She's made a ruling a few days ago. She ruled that there could be 3 reconciliation bills in 1 calendar year, meaning by the time we're at New Year's, you could have some of the angriest GOP politicians ever in the history of mankind who are saying hell no to any kind of stimulus. Let's say we've still got long-term unemployment at the highest level that we've had outside of the aftermath of the great financial crisis. We've just come through a monster quarter for M&A. We've never seen. The first 3 months of 2021 wipes away any merger and acquisition cycle that we have in US history. It's so gigantic. And that means that as consultants politely say, the synergies now have to be realized. And that means that heads have to roll. So you don't know what the redundancies are going to look like between corporate headquarters, et cetera. But there is at the margin a source of continued job losses. So if you get this infrastructure bill, if you get tax increases, then what are the odds that this 6 trillion, and we know that the infrastructure bill is going to be spread out over 8 years, and that the actual infrastructure portion of it is a third smaller than what it was originally conceived to be with Obama, which was only ended up being 6%. Same exact politicians have conceived the legislature. You cannot expect that it's going to be any more productivity enhancing, blah, blah, blah. We're just talking about real economy here. But if this $1,400 stimulus check is the last that we've seen. And all that Biden can do is executive order in a continuation, maybe. I mean, Trump used FEMA funds for a continuation of the extra $300 a week that we're running right now through September the 6th. Markets are forward-looking vehicles. Right now, what companies are going to tell you with this upcoming earnings season that begins with JP Morgan on Wednesday, companies are going to tell you the first quarter was a blow up. It was a blowout. It was great. It was amazing. Going forward, like WD-40 said a few days ago, our margins are getting squeezed. And we don't have good visibility out to Q3 and Q4 in terms of what our top line, what our revenues are going to look like after the effects of this stimulus money has run its course through the economy, which again, Bank of America is inside their checking and they're inside their clients' checking accounts, their customers' checking accounts. They know that a big chunk of the stimulus money has already been spent. We'll see that in a monster blowout March retail sales report that we've got coming up. But again, markets are forward-looking indicators. And what if they decide that what Jay Powell and the Fed is doing is not going to be in conjunction with fiscal spending? Then your wheels start to fall off. And that's what they've been trying to prevent. And that's why Federal Reserve officials spent the last 6 months of 2020 at the podium begging and begging and begging and pleading for fiscal stimulus spending, because they knew that they know that they're trying to hold this whole thing together. They know that they're trying to hold near record valuations together. And they know that there's deep rot inside the investment grade credit cycle that feeds into adverse feedback loop style into the credit market. So this is a huge confidence game that's being played out. And in order to keep all the wheels on, you've got to have continued stimulus spending as far as the eye can see.
I guess with that, looking at the US, right, we have record amounts of debt, right? Debt to GDP is as high as it's ever been, roughly maybe outside of World War II. And looking at like maybe Ray Dalio's book of ways out of our debt, right? When countries become too indebted, there's only a few ways out, right? It doesn't seem like we have any appetite for austerity. It does seem like we have the appetite to try to bail out things, right, through corporate restructurings, and the Fed just buys that on. So, and then it's wealth redistribution and or tons of stimulus, right? I guess, where do you see us on that path? And also from that standpoint, the rest of the world seems to be not in too much better of shape, the developed world, that is, from a debt to GDP standpoint. So does that ever hurt, like, I guess, the dollar, or what hurts our ability to keep up with all this stimulus? Like, people may not like it, but it seems like people are demanding it, and it seems like there's no repercussions to it. How long can that sort of go on? I mean, is there when would the rest of the world reject our ability to deficit spend?
So overnight, we got word that another 6 provinces have been added to China's experiment with its own central bank digital currency. We know that they've done cross-border at this point, even though the border was only with Hong Kong. Nevertheless, 2 separate currencies have now had a successful pilot run. We know that they're pretty much beginning to pseudo-nationalize Ant. They slapped them with a huge fee. And China knows that it's already cornered the market globally in 2 ways. As of the middle of last year, there were 30 airports. This is my favorite stat to throw out. 30 airports in China under some form of renovation, being built new, or modernization. Their infrastructure spending does not require air quotes. It goes directly into building things such that they have infrastructure going forward, as opposed to the dilapidated state of our infrastructure. So they've beat us on infrastructure to a pulp. In the middle of last year, Greg Ip, Wall Street Journal, wrote a story that said, right now, Huawei has 1/3 of the telecommunications equipment worldwide. If Huawei is to cross that line to 50%, such that it has the majority of telecommunications equipment worldwide, then you can just extrapolate that China will have won the technology war. In other words, we've been concerned about soybeans. They've been concerned about semiconductors. And they're not making any bones about Taiwan. We know that the pandemic and our differing reactions to it, our reaction was to blow up Uncle Sam's balance sheet. Their reaction was targeted stimulus that was very much finite in nature, and a lockdown that you can only do in a communist country. So from the end of 2019 until now, we know that they've shaved off from 2030 to 2028 now, when China's economy surpasses that of the United States in size. Now, right now, China is doing a bang-up job of quietly devaluing its yuan. We talked earlier about the fact that they want to come back into the United States and take market share. They know they're not going to have any problem doing it because Yellen announced just yesterday that China's not going to be labeled a currency manipulator. So they can now be more aggressive in devaluing the yuan for the immediate term that doesn't involve fiscal spending, so that Chinese manufacturers can come back and get the market share that they've lost post-trade war, post-pandemic. But if China decides to, after it feels like its economy is on stronger footing, if China feels like it wants to go back on the path that it's been on of allowing its yuan to appreciate, then we could be talking about China's economy surpassing the size of the United States in 2026, 2 years even sooner. So, we're looking at infrastructure spending over 8 years, and they're balls to the wall spending on things that are truly going to make them a globally competitive beast. They know their demographic situation is terrible because of their one-child policy, which means that they're rolling out robots at a much faster pace to make up for what they're not going to have in terms of workers. So the United States needs much different and much more aggressive leadership. And I'm not necessarily talking about leadership in Washington, D.C., but as an economy and as a population, we're going to have to figure out that whether it's the Constitution or really, really strong corporate leaders, we're going to have to do something that gets us off this path, because we're very much sliding into the dollar's losing its hegemony. And the quickest pathway to do this is with a central bank digital currency. And the Biden administration a few days ago said they're concerned about this, they're looking at it, but we're talking about waking up yesterday with our authorities saying, gee, if China's doing it, it's a national security threat, we're on it right now. And we're just not there yet. And the reason we're not there goes back to our entire discussion for the last hour. And that is that if you do have a Fed coin, if you do have a central bank digital currency, if you have a way to deliver money directly to the people, your depository institutions they're fairly irrelevant. And you also open up the specter after more than 40 years of introducing true inflation, rising interest rates into a massively over-indebted economy. So it's your classic catch-22 situation. Oh, Vince, if you're talking, I think you might have hit mute.
There you go. We're about out of time. So one last question. One of our members wanted to know the website you mentioned earlier was Opportunity America with the jobs.
Opportunity Insights.
Opportunity Insights. Okay.
And it literally gives real-time data post January 2020. And shameless plug, please go on Quill Intelligence as well and check out our research.
All right. Danielle, appreciate your time so much. It was wonderful having you with us today. For all of our members, thanks for attending, and we will see you on May 5th for our next event with First Trust. All right, have a good one.
Thank you, you too.